Very warm welcome. Welcome to the FX Week Ahead live market analysis with myself, Giles Cochran, Chief Currency Analyst. Very pleased to be with you here today. Hope everybody's okay. We had a massive week in terms of scheduled calendar events. The last major week before holidays really begin in earnest and some desks close down. So we really do need to watch out for some intense volatility, central bank potential divergences, as well as major data points. So there is a huge amount to be getting ready for. If everybody's okay, just as I'm signing in, make sure that you're aware that any trading opportunities, we talk about entries, exits. The whole idea of this is that you look over my shoulder, someone with a professional trading background, and that helps you see how I go about understanding the markets. And over time, those who attend these webinars increase in their understandings of the fundamentals as well. So without further ado, I'm going to get stuck into the webinar. Now, these are some of the things we're going to be looking at. So first of all, the dollar. Massive focus this week for the dollar with the FOMC meeting. We'll be looking at the Fed fund futures, and I'll be showing you what the Fed is pricing in, and I'll be showing you the narratives that are going on, running over from last week's CPI data. So I will be looking over that, and I'll start off showing folks a quick video to watch so they can really get themselves up to speed with US CPI data. In fact, I'll just send you the link now. It's just a quick, it's coming on the chat box, a quick video. Have a look at this, and that will show you from the CPI data from last week. I put it up on my Twitter feed, so do check that out. We'll be looking at the Australian dollar. Obviously, we'll just be reminding ourselves we're having the RBA last week. And if you remember, the RBA last week took a more neutral stance, which in the context of how heavily sold the Australian dollar is quite hawkish. It was quite a bullish move. So we've seen some support come in for the Australian dollar. And we'll just quickly have a look at the COT report from last Friday and remind ourselves, how heavily sold the Australian dollar is. So that's the first thing we'll look at. Don't forget as well that the pounds, we have got the Bank of England meeting this week. Gold coming into a very strong time of the year. I'll just show you those seasonals, how strong they are, and what we would need to see a really ripper in gold. The euro, I'll just quickly explain to you its funding currency status. And then we'll look at the yen and the Swiss franc and see whether it's time for them to weaken again, and particularly looking at trades like the Aussie yen, New Zealand dollar yen upside, whether that's suitable for potential trading. So without further ado, we'll get straight stuck into the webinar. I'll go over to one of my other screens. Let's just check that I get the right screen. There we go. Super. So let's start with the Aussie employment data. Let me just explain to you as we go through why that's important. You see, the Australian dollar is heavily sold. Now, these large speculators and these leverage funds this is huge investment companies, asset managers, general funds. It's basically the fundamental community, right? So the leverage funds is the fast moving community. Now that's the people who are responding the most quick, with the most speed. So we can see that, look, the large speculators have been heavily short the Australian dollar this year. That's been for a number of reasons. China's growth slowing down. We saw iron ore prices collapsing earlier in the last few weeks. We've seen COVID, Delta variant ripping through Australia, and all of that has been weighing on the Australian dollar. Now the last RBA meeting, if you just want to have a quick refresh, go to my blog, blog.hycmlab.com, Central Bank Watch. I do cover the central bank meetings here, and you can have a little look at that. And you can see that the Reserve Bank of Australia, they really do look to be past their peak bearishness. Okay, so the message that stood out to me was very few negative points in. So the neutrality is in itself a message. So if you look how heavily short the Australian dollar is, and then you have a more neutral meeting, that really does, like I said, this could be a good opportunity for going long Aussie yen. Okay, we've seen the Aussie yen moving up since I made this report back in 8th of December. So That's where we are with the Australian dollar. So we just got to remind ourselves that as we come into the Australian dollar employment numbers, if they're good, that's really likely to boost the Aussie this week. Okay, so watch out for that. So we're going to get into now the events we have coming up. So we start off very quietly. Okay, now if you just take a look at currencies, we can just see, we just have a look here at the currency space. Since the start of the week, we can just see, look, we've seen a mixed bag in the currency space. We're seeing a mixed picture in the risk tone because markets are really sort of quite static. And the reason markets are quite static is because we have all these central banks meeting this week, and there's a very light calendar today. So don't necessarily expect the moves to make much sense today. Markets will really be getting going from tomorrow heading into the rest of the week. So Bank of England's Governor Bailey will be important, particularly before the Bank of England meeting. We'll come on to that, but just look for any hints about whether the Bank of England are going to remain on hold. There's a lot of tailwinds, headwinds building for the UK right now. UK's gone from level 3 to level 4 in terms of its COVID alert level. PM Boris Johnson has set an agenda as of last night to try and give everyone in the United Kingdom a booster by the end of this year in the UK. We've had the first Omicron death in the UK. It's expected by tomorrow that the majority of COVID cases in London will be the Omicron variant. It's become very clear that the Omicron variant is incredibly transmissible. So on top of Boris Johnson having some political difficulties after having or allegedly having a Christmas party in Downing Street after the rest of the UK was on the lockdown, the concerns are that the concerns are that the Bank of England will be on hold and not raise interest rates because of all the difficulties that the UK is facing. Now, we do have employment data out tomorrow, which will be important. So this employment data, I'll tell you what to look for. Average earnings will be very important. Now, the Bank of England is nervous about earnings getting too high, because if earnings get too high, that will mean inflation will become embedded into the United Kingdom. If you think about it, if people are earning more money, that means that costs are going to increase for consumers. There's been some problems in the hospitality sector in the United Kingdom with more and more staff asking for higher and higher wages. And those higher wages obviously translate to high costs, okay? So if earnings really, really shoot up, and you can see they have been rising, if they shoot up higher and they start moving that trend to the upside, that's the sort of thing that would worry the Bank of England. So if we see really good earnings, and if unemployment is really low, and you can see that if that drops, underneath 4, and if earnings move, so the previous was 5.8%, if that's staying up at those high elevated levels of 5.8%, then you'd expect a little spike higher in the pound as a reaction, because investors will think, oh, the Bank of England might be worried about this, and they may have to hike interest rates. Now, if you just take a look at the context, what you can see is this, that the SONIA futures, and this tells you what markets are pricing in terms of interest rate hikes, is for a 0.08 basis point interest rate hike. The current level is 0.10. So in other words, for the December contract, markets are pricing, it's about a 50-50 chance whether we're going to get a 10 basis points rate hike, right? Or 15 basis point rate, it's about 50-50. Market expectations is the Bank of England won't hike. But remember, we would likely see the pound appreciate in the near term if those average earnings are high. So look out for that, okay? That's going to be important. The Bank of England have already mentioned their concerns about earnings. That will be a reassurance that they can hike interest rates And if it's very high, it will be a warning that if they don't do it, something bad will happen. The inflation will get out of control, so they have to. Key, tomorrow, 7 a.m. Now, the core PPI data, that will be important for the US, just showing you, we already know from the last CPI data last week that CPI is nearly at 7% for the headline in the United States. If that's moving higher as well, that just shows you that consumers are going to have more inflation to have to pay for. If producers are paying for more inflation and their prices are rising, eventually consumer prices generally rise. It's not always the case, because sometimes the producer will absorb the cost and they won't pass it on to the consumer. But if the PPI keeps going higher, and if you just take a look here for the readings, you see if that keeps pushing higher, that will eventually translate into costs for the consumer. Governor Orr is speaking. Look out for this. The current, look, if you look at the...
With regards to the early update from Johnson.
If you look, let's take a look here. Look at the New Zealand dollar yen. All right, let me just show you this. Now, the broad outlook for the New Zealand dollar Japanese yen is tilted very strongly to the upside. Now, can you see the New Zealand dollar 10-year Japanese yen yield? See that yield, that bond yield spread between the New Zealand 10-year Japanese 10-year? This means that these jaws, one of these would catch up the other. Now, the reason the New Zealand dollar has been selling off is not because of fundamental policy with RBNZ. The Reserve Bank of New Zealand is very bullish. They're expecting to raise interest rates to 2.6% by 2023. They're currently at 0.75%. Now, when you consider the Bank of England is at 0.10%, the ECB is like minus 0.10%, the Fed is like 0.25%, the SMB is minus 0.75%, Bank of Japan is like negative. Look, do you see? And the RBNZ is expected to raise interest rates to 2.6% by December 2023, and they're currently at 0.75%. So this bond yield spread is supportive of the New Zealand dollar. The RBNZ revised up their trade weight index, they've revised up their GDP, they're expecting to hike interest rates. The deputy governor's recently said, you know, a strong New Zealand dollar suits the RBNZ's agenda. Everything's bullish. So, two things. One, if Governor Orr confirms that bullish picture, then, you know, we'd expect this. As long as risk-off trading doesn't come back in, we'd expect this to eventually move higher. That is now support at that 75, 76 region. Near-term stops can be placed underneath 75, 78. Conservative traders to go with a break of that trend line higher. You expect to find buyers when you retrace that 76.50. The outlook, the risk to this trade is that if we see more risk-off trading. So if Omicron fears grow, if there's more cases, if there's more slowdown, more restrictions, then we can see more downside. Eventually, we expect this pair to recover. Okay, so I personally am long New Zealand dollar yen. I'm expecting the pair to recover at some point. Now, there's always a risk it doesn't, and it goes through that level. So you have to define and limit your risk. So make sure you're always comfortable with your risk, and you've got your stops in place in case the pair keeps going down. Because this is the weakness with macro trading. Like, that's good value, okay? That's better value, and that's even better value. But obviously, look, you don't want to have hundreds and hundreds of points of drawdown. So you have to find little sensible technical levels where you can place your stops. One very sensible place to pop your stops, you see here, you've got left shoulder, right shoulder, head and shoulders reversal pattern. Do check out my blog to understand how to trade the head and shoulders reversal pattern. Absolutely crucial, you know, pattern to be trading. There is got a lovely little site on that I'm sending it in the Q&A, so I'll send it to the chat box as well to check that out. All right. So we'll be looking for Governor Orr to either, you know, and is that head and shoulders. So this level here, 100 here, is a great support level, that 75 level. So if we do get price moving down there, that's great. And stops can be really just carefully placed underneath 74. Okay, looking for a play all the way back up to 80, 82. So good risk reward, it all makes sense. It's not guaranteed the trade will work, right? But you can see the fundamental outlook. You've got the Harami inside bar pattern. That is a nice basing pattern. Do you see how you got these inside bars, so Harami inside bar? They could often be good turning points. That looks like a potential turning point from a technical perspective. So watch out for governor oil in that. CPI data now, the Bank of England are expecting headline CPI to peak at 5% in spring of next year. They mentioned that at that last interest rate meeting. I may have referred to that here in my last Bank of England. It's the 10th of December. See if I've mentioned that here. No, I haven't. It's in the Bank of England communication. They expect interest rates to peak at 5%, right? For the headline. Now, the core is high, 3.7%, 3.4%. Now, if it comes in, above 4%, and the headline comes in above 5.2%, then expect expectations to grow for interest rate hikes out of the UK. The problem that the UK has is that SONIA futures have been dropping lower. But if employment is high and CPI is high, then that could change the outlook for interest rate hike expectations. That's the thing to look for UK. Definitely that CPI data point. Yeah, so just a thought occurred to me. No, that's exactly right. So look out for that, and look out for how that impacts expectations. Now, the Bank of Canada met last week, and they were more negative. And if you just take a look at the Bank of Canada, you can just see out of last week, the Canadian dollar just dropped a little bit, right? So that drop after the last BOC meeting. It picked up as oil picked up, it just dropped a little lower. Now, what happened is that the Bank of Canada stressed two major concerns. One, the Omicron variant. Two, floods in British Columbia. So that was just enough reason for a bit of pause. If the inflation moves very high, then expectations will rise about the Bank of Canada moving towards a more hawkish stance. But what you have to remember with the Canadian dollar is how closely correlated it is to oil, okay? So at the moment, with the dollar strength and oil strength, it gives it a more neutral look. But can you just see here, this is an inverted oil chart. Can you see? Now, if I uninvert the oil chart, what this literally means is as oil rises, right, CAD strengthens, US dollar CAD goes down. As oil falls, CAD weakens, US dollar CAD goes up. So the majority of Canadians' exports are oil, and the majority of those oil exports go to the US. So there is a very, very tight correlation between oil and US dollar CAD. So you can see here, look at that, how close that correlation is. Now, it did break down a little bit during some times of COVID, but that correlation is back in play. So if oil keeps dropping, then expect US dollar CAD to keep rising. Okay, if oil starts rising, remember I've inverted this chart, if oil starts rising, expect US dollar CAD to fall. So that means going to the Canadian CPI data, we've also got to balance oil prices in as well. Okay, so don't forget that. Retail sales, never underestimate the US consumer. That's a market saying. Remember, the majority of the world's GDP comes from the US. The majority of that comes from earnings of employees, and retail sales is driven by that US consumer. It's one of the strongest markets in the world. The US consumer market tends to be very strong. There's lots of demand locked up after pent-up savings. So, I'm expecting another strong reading. If that's a weak reading, that does add another factor into this, arguably one of the biggest events of the week, the FOMC meeting. Now, What's the Fed expecting to do? Now, there's been a lot of speculation, a lot of conversation about this. It's been really, really big. Now, the Fed fund futures are here, right? Now, the Fed fund futures are showing us that markets are expecting 2 interest rate hikes next year. So rates is around 0.25%, and we can see here by the end of December, they expect it to be 0.69. So it's like 2 interest rate hikes are being priced in. Now, if the Fed taper their bond purchases, so what the expectations are is they will taper their bond purchases because the Jerome Powell, the chair of the Fed, has said that they will taper bond purchases. Now the question is, how quickly? The Fed is starting to get worried about high inflation. We saw the last inflation data out on Friday, it's nearly 7%, so the Fed have to act. But they've said that they're not going to start raising interest rates until they finish their bond purchase program. So what Jerome Powell has said is going to speed up the bond purchase program and announce that this week. So if the bond purchase program speeds up to like $30 billion a month, that's quick. And that's going to raise expectations of sooner interest rates. So expectations is that it might go up like to $20 billion a week, but if it's up to 30 billion, then that would really increase expectations of the Fed hiking and expect to see some dollar strength out of that. And like dollar CAD upside would make sense. So also look at what the Fed do in relation to what the euro does. The ECB are meeting on Thursday as well after the Bank of England. So one pair to really keep a careful eye on is the euro-US dollar. And what we might be looking for is if the Fed take a more hawkish stance, but the ECB take a more dovish stance, and the ECB, in contrast to the Fed, are much less concerned about inflation. So because they're much less concerned about inflation, if we just look here, you can see that this is the German bonds yield spread versus the US 10-year bond yield spread. So you see how it's quite flat at the moment, but this could change because if the US become more hawkish and the ECB are more dovish, then we'd expect this to move sharply lower. And you can see how the bond yield spread, as that moves higher, that supports the euro-US dollar. As it moves lower, the euro-US dollar weakens. Now, if we suddenly see a dovish ECB but a hawkish Fed, then look out for more euro-US dollar downside. And likewise as well, like if the Fed are more dovish. Now, the Fed have to be careful because if the Fed is too hawkish, they run the risk of freaking markets out, like they did in 2018, where they kind of got markets really concerned that the Fed were going to hike interest rates too quickly. If the market thinks similar, then we'd have a heavy sell-off in stocks. So watch out for that. But what I expect Jerome Powell to do is to taper bond purchases, but then to become much more dovish. So to really try to break down those expectations that the Fed are going to be hiking interest rates quickly. At the moment, it's just 2 interest rate hikes, and that's okay. We saw the Fed fund futures drop after the CPI print on Friday. Yes, it was high, but it wasn't high as feared because President Biden had sort of got investors worried. And the reason he got investors worried was because they were just getting scared that Jerome Powell was going to have such a high inflation reading, he would be forced to raise interest rates. So even though the inflation was right up at 7%, it wasn't a terrible, terrible print that was feared. And remember, inflation had been above market expectations. So being on market expectations allowed Fed fund futures to drop lower. So keeping an eye on these Fed fund futures around the event will be important. And the expectations will be important and the communication. So watch out for this. You get the statement, but then watch out for the press conference because Jerome Powell will be watching to see how markets respond to the statement. a 30-minute gap then gives him chance to speak in a way that can either calm markets or agitate markets. So look at the event as a whole. That's given us a rough idea of what's happening, okay? Now, on Thursday, got employment data out for Australia. If that's high, so say the employment comes in like above 200,000, say it comes in like 300,000 or above, and say like the unemployment rate is below, below 4.5%, that would be very supportive for the Australian dollar. And I'd look to trade something like the Aussie New Zealand dollar upside. Now, obviously, if the Fed were really dovish, then Aussie US dollar upside would make sense. The Swiss franc, the Swiss hate a strong Swiss franc. The thing to look for here is the Euro Swiss franc pair. Now, if the SNB on their interest rate meeting, if they say the Swiss franc is really highly valued and we're expecting, they say with something like, okay, and we're expecting to be intervening in interest rates more actively to keep the highly valued Swiss franc from gaining too much strength, and expect Euro Swiss franc upside. Okay, that's one to look out for the Swiss National Bank. Then, if you haven't had enough of central banks, we've got the UK Bank of England, and we've already covered what to look for in that. Expectations are for no change. So obviously, if there is a hike in interest rates, expect sudden downside in the euro pound, and you could use the euro pound, just have a sell on stop in place, just a few points below. So say this was the meeting, say the meeting was in like 20 seconds, just have a sell on stop about 8,490. And then if there's no interest rate change, just close the order. If there is an interest rate hike, you'll get taken in with the spike lower and just look to take profit potentially at the nearest support level. That's what I'll be looking for. Looking at the ECB press conference after the European Central Bank, look for how the ECB is responding to inflation. Now, Christine Lagarde has said that she expects inflation to be temporary. Now, her deputy, de Guindos, is like more concerned about inflation. So look, they're going to have a conversation, right? And see how that reacts. Now, if the ECB are still not worried about inflation, that means that the ECB are less likely to raise interest rates. It keeps that very dovish picture in play for the ECB. So look for that. So if the Fed are hawkish and the ECB are dovish, then Euro US dollar downside makes sense. We then have the Bank of Japan policy rate decision. Should be absolutely no change. There's been no change for years for the Bank of Japan. There's no change expected in the near-term future. Should be a total non-event. So obviously, if it is an event, wow, it will have a lot of impact. CPI data out in the euro, that could be interesting depending on what the ECB say. So if the ECB say that they're concerned about inflation and inflation starts rising, you start getting that core reading coming in like above 2.6%, then that will be a concern. What a week we have. I'll quickly cover the gold chart. I'll just quickly show you what's now with gold. I'm running out of time, but do look at this. Look at this article and read this article. It gives you a tip what to look for gold. Okay, make sure if you haven't read that article, read it, because gold is quite simple to trade, and it just shows you how to trade it in relation to what's happening with yields and the US dollar. So once you've looked at that, I'll just quickly show you now, before I've got to go, the gold pattern. Now, there's a ripper of a pattern in gold. And if you just look from, it comes in about like December 20th, and it runs through to about like the middle of Feb, just slightly late in Feb, right? So over the last like 25 years, do you see how much gold tends to rise? Absolutely, Royden, you're absolutely right, O'Reilly. The Chinese New Year's tends to have a lot of gold buying in China, in the Near East. You tend to give gold around the time of the Lunar New Year. You give it to family, friends. It's a kind of lovely gift that you would give to your family and friends as a store of value. The gold in the Near East tends to be much higher value. So in the West, Gold is more decorative. You get 9-carat gold. It's relatively cheaper for the weight and it's more decorative. Whereas in the Near East, when you give gold tends to be of a higher quality and a higher purity, and it's more given as a store of value, right? So that traditional demand for gold boosts gold around the turn of the year. And if you just put here, like from the 22nd, you see how much stronger that demand is, right? So heading into New Year, look for gold. Now, this is what to look for, the bottom line. If the Fed are really dovish, if they're like, we're not going to hike, we're not going to speed up tapering, we're going to be slow, then expect like the dollar to sink and gold to soar. Okay, gold at the moment is just sat in this really key support level around the 1760, 1780 region. And you can see from a technical perspective, we've got that large rejection candle here on the monthly chart. We've got this sort of false break of Rami inside bar. We also have it to the downside as well. So what we have to look out for gold is if the Fed is really hawkish, expect gold to move lower to 1700, 1720. If the Fed are really dovish, expect gold to move up to that 1860, 1900 region. Now, if the Fed are really sort of kind of hawkish, we still may see some dip buyers around that 1720 region. So either way, just watch out for buyers from 1720, but near-term direction should be driven by the Fed. Folks, what a week, what a ripper. I hope everyone's ready for the week. Don't forget, if you're not following me on Twitter, do come along to follow me on Twitter. I will be putting updates as I go along. My Twitter handle is @GilesCoughlinCCA, @GilesCoughlinCCA, and you can follow me along there. And I'll have the, I do have the occasional tweet that just helps to direct people and guide folks, and I can be updating that through the week. So please do stay in touch. Otherwise, folks, just have a really, really good week. Huge amounts of volatility, loads of opportunities. Be nimble, be careful out there, and stay in touch. I won't be back next Monday. I am away on my annual leave from the end of next week, and we'll be due back in the new year. So please, thank you for everyone who's made this trading year a great year. I wish you all a very Merry Christmas, a very Happy New Year, and I am looking forward to being back raring to go for the new year. Take care, everyone, and thank you all very much. Thanks, everyone now. Goodbye.